Gold has been hitting record highs, essentially going parabolic. And the big question on everyone's mind is, will this spectacular rise be followed by a spectacular crash? In today's video, I want to give you my input on exactly where we stand. First, let's look at the scoreboard. Gold went up 64% in 2025. To give you some context, the S&P 500 went up 16%. So gold didn't just have a good year, it absolutely crushed the general market. Not just nominally, but relatively speaking. Now, when you look at a one-year chart, the rise looks steady. It doesn't look that scary, but when you zoom out to the 30-year chart, I don't know about you, but to most people, that vertical line looks scary. It looks vulnerable. In plain English, it feels like it can't just keep shooting up forever without consequences. So, let's look at the history of gold crashes to answer the question, is 2026 going to be the year the bubble bursts? The most famous gold crash started in 1980. Gold surged throughout the 1970s due to inflation, oil shocks, and a collapse in confidence in the US dollar. By January 1980, it peaked around $850 an ounce and then collapsed by 65%. Here is the key concept that most people miss, and you must understand this. Gold does not fall just because it is expensive. Gold falls when confidence in paper money is restored. Let's talk about what actually happened in 1980. Inflation was completely out of control. The public had lost confidence in the dollar. But then Paul Volcker, the Federal Reserve Chair, did something that is impossible to replicate today. He raised interest rates to roughly 20%. Can you imagine that? A 20% interest rate? Because rates were pushed higher than inflation, holding cash suddenly made sense. You could put your money in the bank and earn a guaranteed real return. Confidence in the dollar was restored, capital flowed out of gold and back into the dollar, and inflation was broken, but at the cost of a massive recession. Now, fast forward to today. Under our current Federal Reserve, we are sitting at a funds rate of 3.75%. If we calculated inflation the same way we did in the 80s, real inflation today would be around 6% to 8%. That means right now we are in a period of negative interest rates. If you keep money in the bank at 3% interest, but inflation is 6%, you are losing purchasing power every single day. Unlike 1980, holding cash today is a guaranteed loss. Now let's talk about the 2011 crash. People love to cite this as proof that gold always crashes after a rally. Gold peaked at $1,220 following the financial crisis and all that money printing, but then it fell 45% by 2015. Why? Because the economy recovered, the dollar strengthened, and the Federal Reserve signaled that the emergency money printing would end. Basically, the fear trade went away. Real interest rates moved higher, and the insurance role of gold wasn't needed anymore. The common theme in every gold crash is this. 1, real interest rates turn positive. 2, the dollar enters a sustained strengthening cycle. And 3, confidence in monetary policy is restored. So let's look at today, 2026. People keep comparing this to 1980 or 2011, but the conditions are fundamentally different. Let's go point by point. First, real interest rates right now are not positive. In the Volcker era, rates were 20%. Today, despite what the CPI report says, which we honestly call the CP lie, inflation is sticky. Services, housing, insurance, healthcare, prices are rising faster than interest rates. Gold doesn't need hyperinflation to go up, it just needs cash to fail at preserving your wealth, and that is exactly what is happening. Second is the debt level. In 1980, US debt to GDP was about 30%. Today, it exceeds 120%. This changes everything. The US government simply cannot raise interest rates to 10% or 15% like Volcker did. If they did, the interest payments on $38 trillion of debt would instantly bankrupt the government. They are mathematically trapped. They have to keep rates lower than inflation to inflate away the debt. This is incredibly bullish for gold. The third point is central banks. This is a massive difference. Central banks are buying gold at record levels. They are actively diversifying away from the US dollar. This creates a persistent baseline of demand that did not exist during previous peaks. When the biggest money in the world is dumping dollars for gold, you should pay attention. And fourth, the US dollar lacks a clear long-term bull case. The world is slowly moving away from the US dollar system. In 1980 and 2011, the dollar was the only game in town. Today, there is a coordinated effort by major nations to settle trade in other currencies. So, let's have a realistic discussion about the downside risk. I'm not saying gold can't fall, of course it can, but instead of asking, will gold crash, ask yourself, what kind of downside is realistic? Here are the 3 scenarios that actually make sense. Scenario 1 is consolidation. Gold prices move sideways for a while. It digests the gains. This is healthy and keeps the price stable. Scenario 2 is sharp corrections within a bull market. Gold could drop 15% on some news event. That would feel devastating in the moment, but it is not a crash like 1980. In a long-term bull market, sharp corrections are actually expected. Scenario 3 is a true bear market crash. This is what people fear, a sustained drop. But for this to happen, we would need sustained positive real interest rates, fiscal discipline from the government, which means spending less than they earn, and a strengthening dollar. Ask yourself honestly, do you see the US government spending less money? Do you see them balancing the budget? Do you see them raising rates to 10% and accepting a depression? I don't. We live in a financial system where the currency is backed by nothing. There is nothing stopping them from printing unlimited amounts of it. History tells us that fiat currencies essentially always return to their true intrinsic value, 0. Gold does not fall because it reaches new highs. Gold falls when confidence in fiat currency is restored through discipline and real returns. When you compare today's environment to the moments when gold collapsed in the past, the differences are not subtle. That doesn't mean gold goes straight up in a straight line, but it means the history needs to be understood properly. I am betting on the math, not the politics. If you want to see exactly how I am positioned, what I am buying, and when I am selling, come visit the Seed to Wealth community. It's the best place to stay ahead of the curve, ask questions, and protect your purchasing power. I'll leave the link down below. Thank you for the support. Please subscribe, and I wish you a very nice day. Take care.